To add to the woe, we will know on Friday whether or not South Africa can hang on to its investment-grade credit rating, which affects our attractiveness to global investors. S&P will release its rating decision. It currently ranks South Africa only one notch above sub-investment grade or so-called junk status with a negative outlook. Now, ratings affect the interest that investors charge to lend a country money. Higher rates mean that government will have less to spend on services and efforts to boost the economy. That could mean lower economic growth, less jobs, and even more economic pain. The significance of junk status is that many institutional investors will not even be allowed to lend South Africa the cash.
Economists are divided on which route S&P will take. While some believe South Africa's investment grade rating will be left unchanged for now, others believe the slowing growth and the structural constraints on the economy will work against South Africa. Most believe the probable time for a move by rating agencies is December. It's hoped by then South Africa will have been able to convince rating agencies that government finances are moving in the right direction.
The biggest thing that Standard & Poor's particularly has always lamented about is the fact that potential GDP in SA continue to weaken, and there seemingly aren't structural reforms that are put in place to make sure that growth is sustained at a higher level. In other words, we're seeing growth that is likely to be 0.5 in 2016, and we're seeing a huge number of people unemployed in terms of the increased unemployment rate. In fact, on a per capita GDP basis, South Africa's GDP has not grown in the last year. It's zero growth on a per capita basis, and that I think is problematic on ratings consideration, and that is why they're likely to downgrade SA.
We think that Standard & Poor's is going to allow South Africa some leeway to affect its fiscal consolidation. Certainly the good budget outlined by our Finance Minister in February will take some time to manifest, and I believe there hasn't been sufficient time elapsed yet to actually allow that to be implemented. So I think the agencies probably want to judge what's going on in South Africa, but obviously there is always a risk, particularly given our very weak economic growth.
If South Africa is downgraded, the effects will be disastrous.
Should South Africa lose its investment grade rating, we would see substantially higher borrowing costs. That then means that it makes it more difficult to repay our debt, because we obviously then have a higher cost, so a higher cost of servicing that debt. The worry there certainly is that we could see substantial currency weakness. The Reserve Bank this year, and indeed the last couple of years, has met the weakening rand and the impacts had on inflation with higher interest rates. Obviously higher interest rates slow economic growth, and from that perspective it could have quite a negative growth outcome. Indeed, we believe that if we do lose our investment grade status, South Africa could actually see a recession.
Moody's recently kept the country's credit rating unchanged at 2 notches above junk status with a negative outlook. Standard & Poor's and Fitch have the country's credit rating a notch above junk status. While S&P is definitely giving its review on Friday, Fitch is also expected to release its review on South Africa soon, if not the same Friday. Gloria Sefako, SABC News, Johannesburg.